This is the M3 Report, your show for all things metals, markets and money. Coming up in this episode, I'll be chatting to the former president and CEO of Sprott, Rick Rule, about the state of the US dollar and how its strength is no cause for anyone to celebrate. I'm also joined by Ed Steer of the Gold and Silver Digest newsletter, talking about central banks and watching what they do rather than what they say when it comes to precious metals. Now, usually we try and leave a couple of weeks between shows, but quite frankly, the news cycle is just too good for us to sit and wait for policies to be announced, then retracted, and for currencies to fall, and then recover. Suffice to say, there's a lot happening. So we bring you an M3 report that comes around about as fast as Liz Truss likes to change her policies. Speaking of which, I spoke to resident Brit Jan Skoyles about what on earth was going on over there. So Jan, last week the Bank of England announced that it plans to spend $5 billion a day for the next 13 days, as it warned of material risks to the UK financial stability.
That's right. The Bank of England has, as you say, Dave, announced plans to turn the QE tap back on by buying gilts.
Hang on, I thought the Bank of England were due to start selling government debt as per the MPC's plan to start quantitative tightening.
I know, I'm also confused because new PM Liz Truss has frequently blamed the Bank of England's QE programme for the economic mess we currently find ourselves in the UK. And yet, here she is, 3 weeks into the job and she's doing an about turn.
Well, what happened to change her mind?
Quite simply, the newly elected Brains Truss, which is our new Prime Minister and Chancellor of the Exchequer, decided that the best way to help our struggling economy was to cut taxes. So they announced this by way of a mini budget 2 weeks ago.
So presumably the tax cuts are designed to put money back into the hard-working people in the UK, right?
Not quite. Only as long as you are hardworking and earn over 150,000 a year. Actually, as long as you earn over 150k a year. You don't even need to be hardworking.
And how are they planning on paying for this generosity? By cutting costs elsewhere, I assume?
Not quite. Not really. In fact, not at all. In fact, they've committed to increase spending.
On what?
We've just promised to cap the cost of energy, which means that the government is going to pay the difference between the wholesale cost of energy and the price cap for every household in the UK. And that's going to cost up to £175 billion.
And how are they planning on paying for this then?
By borrowing money on the financial markets by selling gilts.
And how's that going?
Not very well, really.
What do you mean?
We're buying them instead.
You're what?
Yeah. When Kwarteng announced that he was going to start cutting our income and increasing our spendings, the markets didn't think this was a good idea. So they said they wouldn't lend us any more money. It's kind of like going to your bank and telling them that you volunteered for a pay cut at work without being asked to, but now you've decided you want to go on an all-inclusive 5-star cruise around the Caribbean, please. So would they mind lending you the money and then being surprised when they tell you to take a hike, literally?
So where are you getting the money from now?
Well, we'll be printing it ourselves, Dave. This is the £65 billion that you originally referred to. This is £65 billion of additional debt on top of £175 billion from the energy price cap. And factor into that also the lower tax take, which amounts to around £45 billion of unfunded cuts. And soon you're talking real money.
And what do the markets think of that?
It's gone down about as well as a fart in an elevator, to be honest. Sterling is trading like the currency of a banana republic, and the Bank of England may be forced to raise rates in the face of a global recession to protect the currency. It's what is technically known before the watershed as a cluster fudge. The mini budget was designed to boost confidence in the UK economy. It didn't. Instead, it sent the pound to its lowest point against the dollar in history. To be clear, no event has sent sterling lower than Kwarteng's first budget announcement.
So when's the tax cut taking effect then?
Well, they're not.
Sorry, what?
Yeah. Surprised by just how bad the markets thought their really bad idea really was, the Brains Trust has decided to do a complete 180 on it, due to the fact that there was a strong chance that their creative solution might actually collapse the currency, the economy, and trigger a pension and banking crisis.
So they've totally reversed everything?
Oh no, that would be ridiculous. They've just cancelled the tax cuts for the country's highest earners. Apparently, Kwasi and Liz had a little chat with a few people and realised it wasn't one of their best ideas. Can you imagine, Dave, making a mistake like Kwasi has, which then costs the country at least £65 billion to fix, and you still keep your job?
So in short then, Jan Skoyles, printer is coming.
Well, Dave, it's important to remember from a fiscal point of view, the cut to the 45 pence rate was just about the smallest part of the mini budget. What was a £45 billion tax cutting package is now just a £43 billion tax cutting package. This U-turn has in itself essentially no effect on fiscal sustainability. So in fact, yes, printer is still coming.
Stark. Whew. So after all that, After all the chat about when the Fed would pivot, it's actually the Bank of England that's been first. In the last week, the brains trusts have been heard to point to the US dollar's strength and the slow reaction of the Bank of England in increasing rates as one of the reasons why the economy is struggling. I spoke to Rick Rule late last week about the state of the US dollar and how its strength is no cause for anyone to celebrate. Now, we met and chatted, it's probably about 9 months ago, and the world has changed a lot since then. Last time that we talked, you talked about bonds and the bond market being a return-free risk. Now, at that stage, the 10-year US Treasury was yielding about 1.75%, and Fed funds was close to zero. Now, as I say, a lot has changed since then, and we've got Fed funds 3% higher than that. We've got the 10-year yielding about 175. We've got the dollar index at levels that we haven't seen for 20 plus years. And we've also got inflation rates at levels that mean that the real yields are still negative. We've also got what appears to be a debt crisis brewing in the UK. Are we in bigger trouble than most people actually think?
I guess it depends on who most people are, but I think we are in real trouble. Particularly, we're in real trouble if the length and breadth of the investor community returns to understanding fundamental math as opposed to narrative.
Okay.
What you talk about, which is the fact that nominal interest rates are double what they were a year ago, disguises the fact that those same interest rates are still negative.
Mm-hmm.
The US 10-year Treasury yields 4 in a currency that the Congressional Budget Office, not some cranky old bald libertarian named Rick Rule, says is depreciating by 9% compounded. What that means is, despite a doubling in the nominal yield, the real yield is still -5 compounded. Think about an instrument that takes 5% of your purchasing power away every year for 10 years. Think about how attractive that might be. The irony of it is that the US Treasury market and the US dollar, despite its obvious arithmetic challenges, is the strongest major currency in the world. I would argue, David, that this isn't so much a function of the strength of the US economy or US political leadership, but rather the fact that we're competing in a horse race against a bunch of other horses that are completely lame. The irony, I guess, is that the global outlook to some investors is so gloomy that they would prefer to lose 5% in US Treasuries than lose 15 or 20% in other debt instruments or in equities. That in and of itself is fairly scary to me. Now, I'm not a doom and gloomer, but I do think that we have fashioned some economic circumstances over the last 40 years that need to be unwound. And I think that unwinding will unfortunately be very interesting in a negative sense for an awful lot of people, hopefully not you and I.
And that unwinding is going to take longer than most people think.
I suspect that's correct. Let's, just for fun, we talked about arithmetic in the last answer. Let's look at the arithmetic around a reversion to mean in interest rates. If you look at American interest rates over the last 40 years, the mean condition has been a positive real yield, which is to say that savers have expected a real return after inflation on their debt and deposit instruments. With inflation in the United States running at 8.9, that would suggest that a reversion to mean would have the 10-year Treasury with a 10 handle on it. Traditionally, the US 30-year fixed mortgage has traded at a premium to the US 10-year. Imagine the damage that might be done to American housing markets and to affordability if the 30-year fixed mortgage ran up to, say, 11.
Yeah.
Imagine the traditional premium on revolving consumer debt, credit cards, consumer durables. They have traded at a substantial premium to the 30-year mortgage rate. So imagine the difficulty that American or British households would have if their access to revolving credit was at 20 or 22. You have a situation where a reversion to mean will be very difficult for a lot of people. And the failure to revert to mean means that savers in the Western world will have absolutely no incentive to save. I don't know how you resolve this. I'm interested as opposed to eager to find out.
It's kind of damned if you do and damned if you don't, because at those rates that you're talking about, if you have the 30-year fixed mortgage at 11%, that decimates the property market. Among other things, exactly. Getting real yields back positive is going to decimate the economy also. I mean, it seems like an impossible ask, really, doesn't it? Because I suppose the other thing to throw into that is that, you know, we've got the national debt in the US of over 30 trillion. And if rates go much higher than where they are now, you've got a significant issue when it comes to the interest payments on the national debt, don't you?
I think that's correct. Federal, state, and local governments, remember that the Fed would have you focus on the national debt, the national on-balance sheet debt, which is to say the obligation represented by treasuries. They leave out state and local debt. And importantly, David, and I don't know why they do this, they leave out the net present value of off-balance sheet obligations like Social Security, Medicare, and Medicaid. While there isn't a current interest charge on those, the Congressional Budget Office themselves acknowledges that they're underfunded by about $120 trillion. The way that this works out is not clear to me, but I suspect that you're seeing the beginnings of it in the long-term gilt market in London, where the increasing interest rates and the tightening of short-term credits has meant that some of the largest institutions in the UK are experiencing at once funding shortfalls in their pension obligations and margin calls, to the extent that they were playing the yield curve by buying the long gilt and funding it in short-term credit markets. The turmoil in the London gilt market, I think, tells us something about the challenges that global credit markets are going to face if we have persistently high inflation. The other side of the argument, I guess, is that against all odds, some of what the Fed is doing might work. In other words, they might be able, with gradually increasing interest rates, to slow the rate of inflation to the extent that the rate of inflation itself caused the yields to go positive. If there was a hint that that were going to occur, I've seen no evidence of it, but that doesn't matter. I'm not an economist. If there was a hint that that happened, there is so much cash on the sidelines that you could have a relief rally of whatever duration that would rip your face off. I'm not saying this is going to happen, but there is a lot of money that would like to deploy. And to the extent that it looked like, at least in the US, that the rate of inflation was going to slow enough that we returned to real yields, nominal real yields, as a consequence of the slowing of inflation, rather than the continued increase in interest rates, that could be extremely bullish. It isn't something that I see us being able to accomplish as I look at things, but I really need to disclaim for your audience, I'm an investor, a speculator, and a lender. I'm not an economist, and I look at everything from fairly simple arithmetic base.
Okay, two things there. So what you're basically saying as well is that there is a chance that the Fed will get inflation under control. And if they do that, we can return to positive yields by the inflation rate going down, as well
Correct.
as interest rates going up.
Correct.
We don't necessarily know when that inflection point happens and if they'll actually manage it or not. But as you say, you look at this from you're not an economist, you're an investor. Now,
Right.
given what we're seeing at the moment and potentially a developing sovereign debt crisis in the UK, that there could be contagion in the Eurozone or elsewhere, where are you putting money to work? What do you see with your investor hat on at the moment and say, this is what I should be doing?
Well, there are several opportunities that I see, all of which have challenges. I am a fairly large holder of U.S. one-year treasuries. I am among those who believe it's better to lose 5% than to lose 15%. And so I'm holding a lot of liquidity. I'm very afraid that we will experience a crisis of confidence, and that crisis of confidence will yield an event like 2008. There's no guarantee, but I think the possibility is high enough that it's a contingency that I have to insure against. The most liquid market on the planet is the US Treasury market, and the 1 years at 4% relative to any other duration seem attractive to me. The other thing I'm doing, David, as we discussed before we started taping, is I'm celebrating my retirement at age 69 by starting yet another bank. The credit spreads between federally insured deposits and other forms of longer term credits is as broad as I've ever seen it in my life. And I can't help but attempt to take advantage of that. I too, and this will get me a lot of hate probably from your listeners, I'm a reasonably large bullion holder. And one would wonder, if I had an independent financial advisor, why I hold bullion. I'm the largest shareholder of Sprott, which theoretically should do very well in a time of higher gold prices. But at age 69, gold helps me sleep well. And I'm in the ironic position of owning a fair bit of gold and actually hoping that the price goes down. You see, if the gold price ran from US, 1650 to 22 or 2300, that wouldn't prompt an action on my behalf. I wouldn't sell gold. But if gold fell from 1650 to 1500, I'd buy a lot of gold. So I'm in the strange place where my motivation with regards to gold, given my nervousness about other forms of assets, is such that I would rather the price go lower so that I could buy more, rather than the price go up, which wouldn't condition me to sell any. I guess the last thing I'm doing, and your listeners shouldn't do this, we're in a real risk-off environment, and risky environments, and there's no riskier asset class in the world than junior mining stocks. The junior mining stocks, the sort of 150 or 200 that are viable worldwide, out of the 3,000 that pretend, are having a real capital raising crisis. And so selectively, I'm trying to go into a risk-off market and provide capital where no one else will do it, on terms that are reminiscent of the terms that I was able to receive 5 years ago. So I'm actively looking for opportunities to deploy capital among very, very, very high quality juniors, in the absence of any other capital provider.
Given what you've said about holding bullion, what we've seen this year should be a perfect storm for gold and silver, particularly for gold. We've got geopolitical tension. We've got a crisis of confidence, a sovereign crisis of confidence. We've got economies around the world faltering. We've seen fiat currencies, a number of fiat currencies significantly weakening. Why aren't we seeing gold higher in dollar terms?
Well, simply because of the strength of the dollar, I would suggest. I think that investors' conditioned response over the last 40 years has been that the US dollar is the risk-off asset, irrespective of the arithmetic around it. It's important to know that 20 and 25 years ago, investors could park money in US treasuries and get a positive real yield against US inflation. I don't think yet that the reality of the arithmetic around the US Treasury market has impacted very many investors, or those same investors are so afraid of every other asset class on the planet that, like me, they prefers to lose 5% real as opposed to 15% real. The circumstance that we find ourselves in today, David, reminds me of two prior circumstances that I personally lived through. One was 1975, where the US Fed raised nominal interest rates in the United States, greatly strengthened the US dollar, and cut the gold price from $200 to $100. The resulting damage in the US economy and the political reality of a democracy meant that towards the end of 1975, the Fed lost their nerve and backed off. And when that happened, gold went on a 6-year romp from $100 to $850. Similarly, at the end of 2001, the beginning of 2002, we had a circumstance where US interest rates rose, and gold was doing well in every currency in the world with the sole exception of the US dollar. Again, the Fed had to reverse course. And when the Fed reversed course, gold did very, very, very well. I'm not suggesting that past has to be prologue. I'm not suggesting that any of your listeners have an overexposure to bullion. I know lots of people that are 100% involved in bullion, and I think that's madness. But I also think that having no exposure to bullion, if you're a saver, if you have some portfolio to protect, is a necessity. Make no mistake, a negative real interest rate was described by Franz Pick as a certificate of guaranteed confiscation. It is not good arithmetic.
And as I said, we're seeing the dollar index at levels we haven't seen for 20 plus years. At what level or at what stage? Well, first of all, do you think that it will strengthen further from here? And at what stage does that actually become a problem for the US?
It seems as though there's enough residual strength in the US economy, and particularly that the global narrative is that the US economy is a strong and functioning community. It would seem that the Fed can continue to allow interest rates to rise gradually in the near term. And if the interest rate differential between the United States and Japan, the United States and Australia, the United States and the pound, the United States and the euro, never mind the United States versus emerging markets, which are basically, with regards to liquidity, uninvestable. To the extent that that continues, the US dollar strength continues until it doesn't. You may remember yourself concern in credit markets beginning in 2006 about the state of sub-investment grade bonds in the United States and real estate securities in the United States. I remember myself driving to Los Angeles Airport, seeing a billboard on the right side of the highway that said, borrow 125% of the value of your house. Bad credit, okay. I'm not a real estate guy, but I looked at that sign and said, I don't like the sound of this. Did I do anything about it? No. Did anybody else for the 2 years between 2006, 2008? No. The trend in motion continued until it didn't. But when it didn't, the disruption was fairly violent. What I learned from that is to look at today's circumstance as an example, and any sub-investment grades credit that I myself haven't structured or that wasn't structured by Sprott, I've sold.
Right. Okay.
Maybe I miss out in 3 years opportunity cost with regards to excess interest. I'm okay with that. Foregone yield as opposed to destruction of principle is something that at age 69, I'm very much in favor of.
My thanks to Rick Rule for joining us on the M3 Report. And don't forget to subscribe to GoldCore TV to be the first to hear when we release the full interview. Now, as Rick said, gold helps him sleep well. All too often we're on the hunt for assets that generate yields. But we also need to protect yields. Holding gold isn't about watching the price climb. It's about knowing that your portfolio is protected in times such as these. And whom better to take inspiration from than the very people who are driving us towards gold in the first place. This is something that I spoke to Ed Steer about not too long ago. One of our recent videos there was titled "The Floor is Lava" after the kids' game, where when somebody shouts "the floor is lava," everybody has to jump and try and find a safe place off the floor. When you apply that to financial markets, there's very few safe places left.
No, there are absolutely none. The only safe places left right now are in hard commodities. I don't care what it is. When when the large institutions start selling their bonds and getting out of the currencies, there's only one place left for it to go, and that's in commodities. I don't care whether you're talking sugar at one end or uranium at the other end. That's where the money is going to go. And of course, the largest amount of money is going to go into the monetary metals, which are gold and silver. And that's been going on for many years now. If you look at how much silver and gold there is in the various mutual funds and ETFs all over the world, they've gone down recently in the last 3 or 4 or 6 months or whatever, but they're at highs we have never seen since these ETFs and mutual funds were founded like 10, 15, 20 years ago. So the smart money has got a lot of money parked in there already. And it's only when the hoi polloi, the average person in the street, runs to buy some, they'll find there won't be any. But in the end, when paper dies, commodities boom, and the kings and queen will be gold and silver when that happens.
And central banks as well. They've also been stocking up on gold in particular over the last number of years. Plenty of central banks that haven't been buyers of gold in the past have been buyers of gold this year and last. One of note is the Irish Central Bank. They made the first purchase of gold in, I don't know, over 20 odd years. And there seems to be a kind of concerted effort between central banks to increase their gold holdings. Do you think that that's significant, or do you think that that signifies or identifies something?
Yeah, it certainly does. It means that they're slowly sliding towards the exit and trying and hoping that nobody will notice. And I did note that story about Ireland's gold. It wasn't a lot, but it was, like you said, something they hadn't done in 20 years. Mm. But there's lots of other central banks out there. They're not shy about it at all. Russia is one. India is another. Poland, Austria, the Czech Republic, you name it. Every one of these countries out there has been buying 5, 10, 15, 20 tons, either a month or a year, and slowly but surely they're building up their gold reserves. They know exactly what's happening because they're the ones that caused the problems that we have in the first place. And if they're doing it, everybody else should be doing it too.
This is where GoldCore comes in. We are your precious metals specialists, here for all of your gold, silver, platinum and palladium needs. From gold Britannias to silver eagles, from fully allocated, fully segregated gold coins and bars stored in specialised high security vaults around the globe, we've got you covered. Simply head to goldcore.com now and sign up to get started. My colleagues are a friendly bunch and happy to answer any questions you may have. And now to the final and my favourite part of the show. Hire, fire and admire. This week we've got Rick Rule for you. I loved his answer, so please let us know what you think and who you would hire, fire and who you admire. I'm still working on my list. Until next time.
That's hard. Ron Paul's a bit old now. He's even older than I. Somebody in the public eye that I would hire. I'm certain they exist, but I can't draw one to mind immediately. I guess I don't admire his methods. Paul Kagame in Rwanda, I think, has done a reasonably good job of taking an extraordinarily complex sociological circumstance and affecting a good outcome. Earlier in this interview, we talked about my opposition to coercion. Mr. Kagame is certainly no stranger to coercion. But if you merely were to look at results, I think what Mr. Kagame has been able to do in Rwanda, coming out of genocide, is miraculous. Well, the population of ones that I would fire is immense. I, as you've probably gathered, don't have much fondness for the political class. And it would be difficult for me to think of anybody there who I would be inclined not to fire. David, in fact, were I elected to public office, I would demand an immediate recount. I would fire myself in that circumstance. Admire. There are a wide variety of people I admire, mostly entrepreneurs or scientists, company builders. The idea that 6 or 7 pimply-faced kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple, I think is wonderful. That whole class of entrepreneurs, that whole class of people whose individual initiative and brilliance can fund our collective stupidity is just astonishing to me. 2 people I'll mention in terms of admire, and this will cause some consternation, I think. I increasingly admire the Dalai Lama, who, although his political beliefs are challenging for me, his idea that what you change is yourself, that you pay attention to the factors that are under control and you work on the factors that are under your control and you ignore the factors that aren't under your control. That makes an awful lot of sense to me. You can't change the world. All you can do is change your response to it. A person I've really come to admire recently, and I'm reading more and more and more stuff by him and listening to him, is Mike Tyson. What I admire about Mike Tyson is this new sense of self-honesty. Mike Tyson will tell you that he won every fight he ever won 3 or 4 months before he stepped in the ring by doing 12K of road work, running, by doing 2,000 sit-ups, by doing 2 or 3 hours of sparring every day. This whole sense of determination and persistence. Much more recently, I think Mike Tyson has become wise. He said recently in an interview, "Why would anybody listen to me? I've made so many mistakes in my life." That in and of itself is wisdom, as far as I'm concerned. He is on this voyage of self-discovery, and he wears everything on his sleeve. He is radically honest with himself and his audience. So I've become, oddly, a Mike Tyson fan.